Hi there and welcome to the Option Pit Method Trading Gamma. Good to see everybody. And just a reminder that this is for educational purpose only. This shouldn't be considered investment advice. None of it should be considered anything outside of education. It's not investment advice, legal advice, or tax advice. Consult your financial professional. For those of you that know me, I'm Mark Sebastian, founder of OptionPit.com. I founded this company about 6.5, 7 years ago. We are an education consulting company. On top of that, I run a volatility hedge fund called Carmen Line Capital. Well, this is not a solicitation, but if you are a qualified investor and you want volatility exposure, you're welcome to reach out. Today we're here to talk about long gamma and how to trade long gamma. So the problem, all right, options have lots of leverage. Traders are taught the only way to make money is to sell premium, but that's not true. Because if everyone is short options, then who is actually making money being long options? All right, is there a time to buy options? The answer is yes. So what you will learn. What realized volatility represents, how gamma and realized volatility are related, how changes in implied volatility affect gamma, how to set up trades to be safely short premium and short gamma, how to set up free trades to be long gamma. They're not really free. And then I'm going to walk through a few directional plays. Hopefully I'll have you out of here by 9:50 Eastern. So let's talk about realized volatility. Realized volatility is how much the underlying is actually moving. Is the stock whippy or is it relatively muted? All right. Actual underlying movement is called realized volatility. All right. The problem is it's very difficult to measure. Right. I use 10-day HV so 10-day HV is the last 10 days of movement to get a glimpse of how much the underlying is actually moving. Here's the S&P 500. This white line represents how much the S&P has moved over the last 10 days. Right? So based on this guy here, if this is July 13th, all right, this is going to represent the last 10 trading days of movement. So getting out my trusty calendar, all right, this is going to represent the 12th, 11th, 10th, the 7th, 6th, 5th, 3rd, 30th, 29th, 28th. And that'll be your 10 days. Right, so that's what's happened in the last 10 days of movement. It's not an average. It's actually a calculation called GARCH. All right, where we calculate daily implied volatility. All right, and that's really what it amounts to. So it's not an average. If you are buying options, do you have to get the price direction right? No, you don't. Sometimes. Is that the same formula for all platforms? Most of them. Most of them are using GARCH. There are other forms of realized volatility, but for the most part, GARCH is kind of standard. There are other ones. You know, there's average daily range that can affect things, a few other things. But generally speaking, most platforms use the same formula. So it's really just where did we close yesterday, where did we close today. That's where GARCH comes from. And that's an acronym, and I forget what it's like. So, yeah, GARCH. I forget what GARCH stands for. One second. I can actually tell you. It's something stochastic volatility here. GARCH. GARCH is generalized autoregressive conditional heteroscedasticity. Try and say that 10 times fast. You know what? Just because data is working against you doesn't mean it's actually, in a model sense, doesn't mean it's actually working against you. That's what it comes down to, Greg, and that's what we're going to discuss. So over the last 10 days, the S&P has moved at an annualized rate of just over 10%. This means that if the underlying were to continue the pace of movement, it would likely be up or down 10% a year from today. So we're talking about movement about 245 points between now and the next year on this date. So we'd be talking, 2450. So what is that? Talking 2200 to 2650, 2700, something like that. All right, so it's an annualized number. So, let's look at how predictive 10-day vol is, and it has and has not been. So if you look, take a look at this price chart, and you can see a year ago, 10-day realized vol was like 12%. All right, so on an annualized basis, they were looking for 12% movement. Well, you can see movement kind of died. But actually, if you look at where it was on the date, we're about 2150. And we closed a year ago or a year later at 2450. That's, that's about 12%. Can you find HV on platforms like TOS? You can. All right, and what HV isn't really meant to be predictive, but it's interesting the way that movement can actually be foretelling of what movement might be like. All right, you can see right here, right here over this 10-day period, movement got up to like 17%. And you can see the movement. This is during kind of that during election a year ago, right? Look at this, up, down, up, down. This is all Hillary. Hillary's in trouble, then Hillary stops being in trouble, and then overnight Hillary gets in deep trouble, and then it's off to the races. Right? Then Hillary loses and it's off to the races. But it's really amazing the way that, if you really look, after kind of November, movement kind of stopped. We got down to about 6%. And if you look up here, we're right below 2,300 when everything dies. And really, this is December. It's been 9 months, and really we've had like one little period where we did a bunch, kind of made a run from 23 to 24, and really haven't done much since. So it's interesting the way that HV is backward looking, but actually gives us a glimpse into, how movement might change. All right. So HV is not predictive, and it doesn't try to be. But it's interesting the way that it can be foretelling on an annualized basis of what things might be like. Andrew, HV is not predictive. It is real, right? Yes, that's correct. But interestingly, I think it can be kind of predictive, especially when it's winding down and winding up. And we're going to talk about that. But movement tends, one of the things that I think people forget about, all right, shows wide or narrow the battlefield is. That's exactly right. And what it really is that a lot of people don't realize is that movement correlates to movement. So as the market moves more, it actually leads to more movement. And when the market is moving less, it leads to less movement. Does that make sense? So, like, think about it this way. You know, there's no direct relationship between hitting foul shots, but if I hit one foul shot, I'm more likely to hit my second and my third. You know, and then if I miss one, I may be more likely to miss my next. You know, especially with what they call streaky hitters. There is statistically, there's not supposed to be a correlation between each shot, but there is. Does that make sense? All right, so why does this matter? All right. While we often spend lots of time on a direction, we spend little time concentrating on the movement. Both are important in being long or short options. Between delta measuring direction and gamma measuring movement, we can make great trades. Let's discuss the two. Delta is an option sensitivity to directional movement. All right, we all know this, hopefully. A short delta position will lose value when the underlying moves higher. An option is worth $1 and has a short delta of 0.3. A dollar move higher in the underlying and the option will be worth 70 cents. A short delta option position will gain value when the underlying moves lower. All right, the option will be worth an option is worth $1 and has a short delta of 30 cents. Dollar move lower in the underlying, it'll be worth that option's worth $1.30. Real simple, right? It's just delta times move, and you get your change in the options price. Right? If you just write down the math, it's easy. All right, delta. All right, a long delta position will gain value when the underlying moves higher. Option's worth $1 and has a long delta of 0.3. Dollar move higher in the underlying, and the option's worth $1.30. All right? If it's worth $1 and it has a long delta of 0.3 and it moves $1 lower, the underlying option will be worth 70 cents. Real simple. So the question is, we know there's no autocorrelation in prices. That's the thing, is there is autocorrelation between volatility. Most people believe there is autocorrelation in volatility. And I think that's one of the things that really changes things. Correct. And that's what makes buying premium smarter if you know what you do. All right, so option delta can be as high as $1 or as high as 1 or as low as -1. And yes, there are weird exceptions where it exceeds that, but I don't really want to get into that because they don't really matter. All right, this would, if it's $1 or -$1, that basically means it moves in lockstep with the underlying. So if it's long 1, that means if the underlying moves up $1, the option gains $1. If it's short 1, that means the underlying moves up $1, the option loses $1. And if the underlying drops $1, the option gains $1. Real simple. Call options have long delta if they're owned. So if you own call options, you are long delta. All right. If you are short delta, if you are short call options, so you sell a covered call, you are selling option delta. You're selling correlation to the underlying. All right. Put options are short delta if you own. So if you buy put options, you are short the underlying. And they are long delta if sold. Again, real easy. Delta is not stable, and this is where gamma comes into play. So a stock is trading 50. What is the delta of the 50 strike calls and puts? This is really easy. I'll give you 1 second to answer this. Stock is trading 50. What is the delta of the 50 strike calls and puts? All right, so the good news is that most of you said 50. That's great. So each of them is going to be about a 50 delta. All right, so now the stock rallies from 50 to 55. What is the new delta of the 50 strike call and the 50 delta and the 50 strike put? No, it's not going to be 1. It's not going to be this at 1 minute to expiration. Yeah, I mean, so let's put it more simply, what's going to happen to the delta of the 50 call? Is it going to go up or down? Yeah, it's going to go up. And what's going to happen to the put? It's going to go down. And for those of you throwing out random delta and deltas for the calls and puts, 1, good job on being ballsy. 2, you don't know unless you know how many days to expiration and what the volatility is, right? So if it's a $50 stock and it goes to 55 and it has 3 years to expire, there could be almost no change in delta. If it expires in 2 days, the delta could be 100. But the way we measure that, and many people, if you ask this, they said, well, what's the gamma? And the measurement, what measures the change as the underlying goes from 50 to 55 is gamma, because delta is not constant. So gamma is how the delta changes with movement in the underlying. It's often described as an option's sensitivity to movement as opposed to direction. So if you think about it, delta is slope, so delta is speed. All right. Delta could also be called acceleration, and gamma is the change in acceleration. All right. Gamma P&L is going to be more visible in a volatility chart than a price chart. So here's a case where if I bought premium on June 16th, you think I made money? Well, it depends what I did, but probably. Yeah. So what this is telling me is that if I bought here, and movement has increased, tells me something good is going on, at least from a long premium perspective. This is a very hard period to be short premium in. A lot of people love trying to sell premium in these moves, and they don't realize that they're banging their head against the wall. All right, now here's EWG. This is Germany. So if I bought in here, ignoring the dividend, but let's say I bought in here, have I been making money? Same period of time, right? Short premium stuff hurts when things move, right? And long premium does well. This is what I don't get is everyone's, you know what, there is a quote-unquote edge in selling premium, but it's not this end-all slam dunk that it gets laid out there, all right? Only about 50% of option premiums are actually overpriced, all right? 30% are fairly priced and 20% are underpriced. So if you don't know what you're doing, you're basically 50-50 you're going to make money. Well, maybe you're not doing it right. Right? There's actually techniques to this. All right, so let's just reel back of the envelope, talk about how to calculate delta. All you do is simply add the gamma and the price movement to equal the delta. So my position is long 50 deltas. I'm short 1 gamma, 0.1 gamma. Underlying moves 2 points higher. my new delta is 0.3. All right. Now, here's position 2. My delta is negative 0.5, and I'm negative 0.1 gamma. Underlying moves 2 points higher. My delta is now negative 0.7. All right. One clear thing. All right. Is the sign of gamma and the sign of delta related in any way, shape, or form? You mean always sell premium when IV is high? No, I do not. No, they are completely unrelated. All right, so here's my, all right. So someone said go slow. How did you get 0.3 and negative 0.7? All right, so my delta is 0.5. My gamma is negative 0.1. Well, negative 0.1 times 2 is what? Negative 0.2. Negative 0.2 plus 0.5 is 0.3. Got it? Negative 0.5, and my gamma is negative 0.1. So the underlying moves 2 points higher. Negative 0.1 times 2 is still negative 0.1, correct? Or negative 0.2, correct? Negative 0.2 plus negative 0.5 equals, what is back of the envelope? When you're at a restaurant and you're doing some math, or you're at a meeting and you don't have a piece of scratch paper, you grab the back of an envelope. You know, you've got like a letter in your pocket or something, and you kind of quickly do math on the back of an envelope. You know, have you ever gotten a letter and you write down like your shopping list or something like that? That's what back of an envelope means. Is one possible to trade structures of 0.5 in a short put? For sure. I mean, that's basically selling an at-the-money put. Is one possible to be long 0.5 and long 0.1 gamma? Yeah. A letter is something historians can explain. What? No, you don't. No. It's the other way around. Because if you're long gamma, if you're right. All right. Must have been on. That's funny. All right, so let's keep going. All right, to sell gamma. All right, so let's talk. I'm going to talk about short gamma first. All right, what do you want? You want falling movement and overpriced implied volatility. All right, IV can lead movement, but not always, and loss often than many people think. You know, implied volatility is only correct about 50% of the time. You know, IV will lead movement in equities, but a lot of times in indexes, movement leads IV. So all of you SPX traders that think you're trading implied volatility, you got to understand that movement a lot of times leads VIX. Things like S&P, the RUT, the NDX, movement will lead implied volatility. IV overstates actual movement, or yeah, about 50% or more. IV overstates actual movement more often than not. Yeah, about 50% of the time. About 50% of the time. In some of the indexes, it's higher than that. But over a wath of individual equities, it turned out to be about 50% of the time. It's about right 30% of the time, and it's too cheap about 20% of the time. I don't know where you got 75%, but that would be fascinating. This job would be much easier. SPX might be closer to 75%. However, when IV is wrong, it is really, really, really wrong. That's one of those stats they send you that's a little off. Yeah, it's overpriced 75% of the time, but when it's underpriced, it's really underpriced. How can you tell? Well, we're going to talk about how to tell if IV is overpriced. Well, that's skew. That's its own thing. Yeah, it can hurt, right. Isn't IV more an effective than cause? In other words, the market moves, and then about when it's ready to settle down, IV is at its max. Sometimes, but not always. For index, why movement leads IV? Why the opposite? You know, IV will be overpriced, but it'll actually take a major move to make IV move is what it comes down to. So IV is pretty predictive of low vol, but terrible at predicting high vol. Does that make sense? Especially in major indexes. So let's take a look at some periods of time where you can sell premium. This is right now. I think ExxonMobil looks like a really interesting premium sale. Its IV has been climbing. Yes, it has earnings, but it's really, the movement's been climbing, but they've overreacted on the implied volatility. All right, but it's really overreacting on implied volatility, and that's because of, you know, the IV of XOM is more related to oil than the actual movement in the underlying. So I'm looking at ExxonMobil as a really interesting premium sale. So when do you buy gamma? So like I said, I want falling movement and overpriced IV. Something like that. So when movement is above IV, here's when I buy gamma. When movement is above IV, when IV is at near all-time lows or recent lows, and IV, when it gets cheap enough, it is almost always a buy. So here's an example. Look at the autos. Look at, I mean, I can show you a whole list of ones that were interesting. But here's AZO. This is one that I've been calling long premium for a while. I mean, it started to move more than its IV, and the IV was dirt cheap. I mean dirt cheap. You were a complete clown if you didn't own premium back here. And actually, I think IV is still too cheap in AZO. But, you know, let me throw up a couple others. Here's Alta. This one got way too cheap. Just need the chart to show up. I mean, take a look at where Alta, so take a look at a chart of Alta. I mean, this was just insane. I mean, look at this. The IV just stayed low, 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 low. I'm going to get rid of the other two. So the IV just stayed dirt low. You could have bought all the premium you wanted here on the 26th when it was 290. You know, let's take a look at what premiums, what the straddle looked like. Let's take a look at the July straddle. So we're talking pretty well out. So that I could have bought the July straddle when this thing was trading 290 for let's call it $11. How do you think that paid out? So in AutoZone, I actually did a long call trade that got beat, and then I flipped it to long puts, which are winning. All right, and we're going to talk about how to trade this stuff. And normally I don't just do straddles. I'm not a big proponent of those. But I am going to talk about how I trade these things. So when HV is above IV, that is a good time. Well, only if IV is really, really low. Yeah, so the white line is 10-day HV. The red line is IV. Yeah, that was a nice trade, right, Tom? My only issue was I traded some of these via long call, which is also fine, but that was more of a directional buy. So let's talk about getting short premium. To get short premium, I want to find IVs that are falling but high, HVs that are sinking, favorable term structure, and a steep skew. Simple short gamma trades are short iron flies or a short iron condor. All right. One way to get long premium is to find IVs that are in the dirt and become a net over or premium. And this can be done by a back spread when skew's really steep, a ratio calendar, or a short iron butterfly, long butterfly. And that's when skew is cheap and at the money vol is cheap. So here's WBA. Otherwise known as the Walgreens Boots Alliance. Who doesn't love the Walgreens Boots Alliance? All right, so let's look at what we have. I have while the next 2 weeks look pretty flat, term structure isn't exactly awesome. All right, I've got HV sinking, and I have IV falling. And if I look at August, I can get some decent premium here. Look at HV10 to IV. And you can see HV20, HV10, HV30, HV10. So what do we have? Falling movement. Sigma is implied volatility for the contract. It's kind of a net implied volatility. So here's just a simple idea for that. I mean, I kind of like an August iron condor. $2 wide, 50 cents. I think you'll get 50 cents out of it. It's got, a month ago, less than a month ago, pays out, needs a 5% move, which I don't think we're going to get, and is paying out, pays out 33% on risk. Real simple trade. But we're actually here more to talk about long gamma. So let's talk about SPX, and here's some things I'm doing in SPX. And these are things I'm legitimately some things we throw out all the time. When we run Option Pit Live, we run our strategy letter, we run our, and we put out some different chat ideas. I mean, there was one day when the Whole Foods Amazon takeover came out, I called out a trade, and I think there were 30 or 40 people in the room, and I think they net made close to $1 million. Just a guess. I mean, I can name one guy in particular that made 6 figures on that trade. But here's SPX. This is something we throw out different ideas on SPX all the time. Let's take a look at this guy. And I've got a few ideas for SPX. I'm going to talk through two ones that I like. So, and I'm going to tell you what I have on after that. So I look and I see July. You know, there's a few little cute trades that I like, but July 650 and the August 2s are 678. All right, the July 31s are 662. So I kind of like owning term structure in this trade, and I can see that implied volatility is below movement, like remarkably below movement. All right, it's remarkably below movement. So that's the one thing that bugs me. But I've got this sinking IV, which tells me something, an IV that's really cheap. So I'm a little wary of selling premium, but I definitely don't, with an IV like this, it's hard to want to own premium, isn't it? So I'm going to give you two ideas, both of which I kind of like, and then I'll tell you what I threw on. So this is a ratio calendar. And you could do this in SPY as well. So imagine selling 6 of the regular Julys against buying 10 of the AUG 2s. All right, this is a ratio calendar. So you end up with a position that pays almost nothing. Right, I've got 10 S&P contracts and I'm paying 56 bucks a day. And if we move, I make money. Is that theoretical price? Sigma? What is Theo? Theo is what my Theos that I'm running at the time are saying. So, you know, that's just, so one of the nice things about LVX is that it lets me set my own implied volatilities. And you can see the IV is cheap compared to movement. Theoretical, right. This is not a double calendar. This is a ratio straddle swap. So it's actually a straddle, short 6 straddles versus long 10 straddles. And the idea being that if things move my way, it's not a double diagonal because they're all the same strike. See, they're all 24.5. That's not a double diagonal. So ratio double calendar, right. Or a straddle swap, you could call it. And the idea being is that I may want to carry this thing all the way expiration, and I may just want to own this straddle after expiration or sell something else against it. So, believe it or not, you know, is there a difference between 12 call calendars, 12 by 20 call calendar, 12 by 20 put calendar versus 12 by 20 straddle swap? Not really until we get to expiration. And because I may carry this for a while, I may want to hold on. I may actually want the AUG straddle as opposed to just calls or puts. So this is a trade I really like, and I really think the Greeks are favorable. I'm paying nothing to get movement exposure. Right? If we make a run at 2,400 bucks and vol rallies, I make 6,500 bucks. We make a run higher and vol sits or stays the same, I do well too. So that's why I like this trade. Now here's the other one I like. So if I use standard deviation, I get it tells me that it wants my, on August 2, it tells me I want my wings 38 points wide. So that would mean I'd set my wings 35 because I cheat in. And I can set up a 35 point wide butterfly, and I pay about $21 for it. Again, a little more vol, a little more cost, but I don't need a lot of movement, and especially over the next couple of days, to do extremely well. All right, and if I want to get cute, I can actually take this trade and sell like a VIX call spread or sell VXX call spreads against this, something I'm going to talk about in a little bit, and I can actually have this gamma on for nothing. But like, look at the risk reward here. I'm risking $6,000 to make 13. Yeah, there's some fun things you can do. How do you calculate the 6/10 ratio? Yeah, gamma for almost nothing. I mean, $200 for 8 gamma on a $2,500 index is just insane. That is cheap. Now this is a 10 lot. So one lot, you're really talking $20 a day. And you'd be looking to make $1,300. You're going to have trouble losing these. Can you do these in the smallest possible route? Yeah, sure. You know, you could do this in SPY. You could do it in like 3x5 in SPY to do that ratio calendar. Sure. All right, let me look at let me look at some of the indexes here. Let's look at RVX. So I'm going to look at IWM. And I'll walk through this one real fast. Here's another one where movement is sinking, but IV, I mean, look at the IV. I'm going to turn this off. Rutvol is the cheapest it's been all year. You think that's a sale? Movement's higher than IV, but not much. All right, so then I look at my term structure. I mean, that's an interesting looking calendar right there. That's a little much. So let's just look at July. Let's just stick to something easy. I don't trade a lot of IWM, just an FYI. So let's just do a 5 lot. And my 5 lot produces 64 gamma. 64th date, 161 gamma. And let's go to regular August. Nope, we're not going to go to regular August. We're going to go to the Aug 11s. Why? Because I want my half strikes. How about this guy? That's not bad. You're like paying nothing. You're collecting premium, and if we move, you make money. All right. All right, so let me walk you through 2 quick scans we actually have in Live Vol X. Find a stock that is at a 52-week high. Find a stock that has an IV at a 52-week low. Buy call that's 1 to 2% out of the money and wait a week. And one we were looking at was IYT. I mean, you don't even, this is right at the money. But take a look at this. IYT is 175. This has over a month to expire, and it costs less than 2% of the stock. That's a cheap trade. No, you will not. That's where it gets a little tricky. What do you do when gamma becomes more negative? Well, you can actually adjust how many options you own or how many you're short. Real simple. So here's OP scan 2. This is our straddle finder. We actually have a straddle finder in LiveVol. HV10 over HV20, middle 52-week range for the stock. It's been up for 3 days in a row, and IV is in the bottom 20%. So we ran this scan and one that came across ISBC. This is not one I know real. Investors Bank Corp. So you see IV pretty low, HV10, HV20, and we ended up with a 12.5 straddle that looked kind of favorable to us. These are both actually, if you go in LiveVol, you can actually see the scans that we do. Got a few in there. We're building out more. All right. So in summary, gamma is an options exposure to movement. Owning premium means rising movement and stable IV. Selling premium means falling movement and falling IV. And scan for good trades using IV, HV, and term structure. All right, so I want to tell you about this thing we've got going on. A week from Saturday, we're going to be doing a 3.5-hour class on buying straddles, strangles, owning long gamma versus VXX and UVXY. And what we're going to really do is teach you how to buy straddles and strangles, how to trade long gamma on their own, and then we're going to add in using VXX and UVXY to actually hedge off a lot of the decay and theoretical risk. And you can end up with some really unique trades. Just an example, we develop a lot of trades that are long S&P straddle, long VXX put, or short VXX call spread. And the idea is you're short vol in VXX, long gamma and volatility in the S&P 500. And that could be really interesting. And you'd be surprised how many of my scans end up with S&P and diamonds or QQQs in them. So you go to optionpit.com/long gamma. When this goes in our store, it's going to be $300. We're going to do the live class because I have to record it live so that we can put it in the store. And I like having live bodies, so we're going to do $197, and you can take an extra $25 off. Use code 25_OFF. OFF is all capitals, people. I got a lot of people saying, the code doesn't work. Well, it's because you forgot to all capitalize it. And you go to optionpit.com/long gamma. That is incidentally also where I'm going to be dropping the replay of this webinar if you want to review it. So tomorrow you get an email saying, hey, review the webinar. Well, guess what? It's going to be on the landing page for this. And we're going to talk about how to trade straddles and strangles, how to sell them effectively, how to trade them back and forth. All right? And again, the webinar will be right here in the middle of the page, optionpit.com/long gamma. Any questions? I'll take a couple more. It's already almost 10 o'clock Eastern time. When comparing major indices, look like the past few weeks, NASDAQ is more volatile than S&P. We'll trade like long straddle in NDX or Q short straddle in Q. Yeah, I mean, we do, that'd be like a straddle swap. That's like correlation trading or like a, you're doing correlation trading is really what that is. And that can work. I'd actually more likely trade it the other way around because you're looking for mean reversion as opposed to the other way around. But yeah, that absolutely can work, and there are people that make a living doing those types of trades. Do I have to have the LiveVol platform take part of these trades? No, you do not. All right, and the $25 off thing is going to be good through Monday. So After Monday, that's not going to work. What are good conditions to sell an iron condor? Falling movement, falling implied volatility. What capital is required to open an SPX options account? Not that much. How do I create your scans in TOS? Well, you can create them with using HV and IV. For SPX trade, you said that the IV is cheap. Cheap compared to what? Compared to movement, Trevor. It's been moving around a lot, and the IV is below that level. Can I write down the scripts and send them out? Take the course, and I'll write you every single script that we have. Do I always use HV10 for gamma trades? No, I look at HV20 some too. Depends on the specific stock, but I think HV10 tells me the best of like what's happening right now. Sometimes. To recap, so when HV is above IV, that is a good time to buy options. Sometimes, not always, but it tends to be favorable. Do I need our platform to make these trades? No. Correct, Greg. HV10 is just 10-day period realized vol. Correct. Thank you. All right, folks, go to optionpit.com/long gamma. And George, that can happen, but then you just don't trade it. No, and no, they don't need to be monitored constantly. I don't set up trades that way. All right, guys. Hope everybody has a great day, and I want to thank you for your time. Have a good one. Good night.